I'm honored to have a very special guest join us in today's episode, the founder of Siegel Asset Management. In this episode, we cover a topic we haven't looked at before. We discuss the energy sector, specifically midstream companies. Yves shares with us his guidelines for investing in energy dividend stocks. Hi, I'm Kanwal Sarai, and welcome to the Simply Investing Dividend Podcast. Yves has been recognized several times by the Wall Street Journal's Best on the Street survey for stock picking, and in 2018 received the Ammys Hall of Fame Award in Research and Analysis, an honor recognizing excellence and contributions to the North American energy infrastructure sector. Additionally, Yves contributes to mainstream media including CNBC, the Wall Street Journal, and the New York Times as a recognized expert in asset management and investment strategy. We talk about dividend investing, how to select the right stocks, and investor behavior. Let's get started with the interview. Yves, welcome to the Simply Investing Dividend Podcast.
Oh, thank you. And good afternoon.
Good afternoon. We are so happy to have you on our podcast today, Yves. You've got tons and tons of experience, decades of experience. You are, as we've chatted before, an income-oriented investor, and that is our audience. That's what they look for, is income from their investments. So why don't we start off with the first question? Yves, a lot of the folks may not have met you before. They don't know who you are. Can you tell us a little bit about who you are and what are you focused on as an investor?
Oh, okay, sure. And by the way, when you say decades and decades of experience, that just says I'm old, which I'm not going to dispute. But my background is such that I started in the securities industry as a equity analyst for some of the big sell side firms that you're probably familiar with: Lehman Brothers, Smith Barney, Credit Suisse. And my focus was on an energy, and then at some point in time, I left the brokerage business to do a hedge fund, which everything's about timing, which was just during the credit crisis in 2008, 2009, and then I left to go to Credit Suisse, do the same thing, focus on energy investing, and then I left to go to the portfolio management side. I went to Neuberger Berman. I was there for just about 8 years as a portfolio manager. With our product was really energy master limited partnerships, which is an income dividend strategy. And then in 2020, I decided to become entrepreneurial and do it on my own. And that's when I set up Siegel Asset Management Partners. And I absolutely love what I do.
Oh, that is great. And I know, having looked at your website, and we've chatted before we hit the record button, your focus is on midstream energy companies. Now, a lot of folks in the audience may not know what that is. Can you explain to them what is midstream energy companies?
Sure. When you think about energy, the energy value chain, you have upstream, which is the exploration and production companies. Those are the companies that look for and produce oil and gas. And then you have the midstream companies that connect those companies or the oil and gas to end-use markets, such as utility. They'll transport the energy to end-use markets, such as utilities. So midstream, the way to think of midstream in the simplest form is think of pipelines. And what I love about it is it's really infrastructure, and they really have little commodity price risk because what they're doing is really just transporting the molecule to the end-use market.
Yeah, no, that is a great explanation. The biggest thing for me, the biggest eye opener is, you and I chatted ahead of time. For me, the biggest eye opener was the importance of these types of companies. I'm going to be honest with the audience here. I'm kind of naive. I didn't pay a lot of attention to this. I was under the the belief, because you just read so much in the media and everywhere else, where people believe that there is no future in oil and gas. It's a dying industry, right? And having after spoken with you, that's not true. Like, is that, how do you react to people who say that there's no future in oil and gas, in fossil fuels?
Yeah, the way I reacted, whoa, that's a great misperception. Today, fossil fuels, oil, gas, and coal represent about 82% of the total energy consumed globally. And by the way, that's been really stable for decades. And that's not really changing all that much. And one of the reasons that it's not changing all that much is because energy use, continues to grow. And I just don't see that changing anytime soon, because you have population growth, and then you also have economic growth, and to fuel those, you need energy. And so fossil fuels today represent just a significant amount of energy. So that's number one. And then number two, folks think, well, if we don't use oil and gas, what sources of energy are out there? Well, you have nuclear energy, and nuclear energy in the United States basically supplies less than 20% of energy that's used to generate power, and and that's very, very difficult to build new nuclear plants. I mean, those are $1 billion type of investment that takes years and years to actually get permitted and get completed. And the last couple that were built in Georgia were well over budget. I mean, billions of dollars of over budget, and took quite a long time to actually get done. So that's one part of the equation. So then you ask yourselves, well, what is also viable? And then folks think about wind and solar, renewables, especially when folks think about climate and trying to reduce emissions. And the renewables represent maybe 15% of global energy. And yes, that's growing very fast. But renewables also have their own issues, which is the intermittency problem. And I'm sure the folks have heard about the fact that the wind doesn't always blow and the sun doesn't always shine, and so you need really reliable energy 24/7. And fossil fuels are the type of energy source that can deliver that. And then you go beyond that. You think about not only reliability, but you also want to make sure that it's affordable and also available. And fossil fuels really tick those boxes off, or check those boxes.
Yeah, absolutely. Those are great points. And I think another misconception is everybody's talking about electric vehicles,
Yeah.
right? And everything's going to go electric. But the energy density isn't there yet. If you think about aviation, you think about trains, ships that have to move large amounts of cargo and passengers. Um, I don't see that turning into electric planes or electric ships anytime soon.
Well, not today. Maybe well into the future. And the other thing that I was remiss in answering the question too is, people probably don't recognize that petrochemicals, which come from natural gas and come from oil. I mean, those are essential items that you're not going to get from wind and solar. You have basic industries such as steel, that aluminum, that you need the temperature to be so hot to form the steel, that you're using natural gas in the process. Pharmaceuticals, where they come from? Well, they come from the petrochemicals. They come from oil. So there's essential services, or essential uses that just can't be replaced by wind and solar. So regardless of the debate about when you'll see peak oil demand, uh, it's not going to fall off a cliff. It's going to be around for decades and decades. And then you think about power demand, which is growing for the first time in decades. You're actually seeing electricity demand grow, and uh, natural gas is going to probably be the number one way that we're going to meet the electricity demand going forward. And that's power demand coming from data centers, which have been in the news for quite some time. Um, Electric vehicles, well, where's the power to charge the batteries to be able to drive your electric vehicle? Where is that going to come from? Um, and if we have reshoring in the United States, the industrial demand for power and electricity is going to require more energy sources, and natural gas. I think natural gas has a really, really bright future, significant amount of growth. And the last thing I'll say before boring people is when you think about the United States, Donald Trump likes to say energy dominant. I like to say that we're energy independent, and we're producing more energy than we can consume in the United States. So we have a huge export market, especially for natural gas. And the way we're exporting natural gas, we're liquefying it and shipping it abroad. And the demand for LNG, as liquefied natural gas is called, is really going to supply the world, especially given the problem with Russian gas that was shut down when they invaded Ukraine. So that's a huge source of gas demand. LNG exports are going to double by the end of the decade. So that's essentially why I really like the natural gas story more so than the oil story.
Yeah, and the other question I had, like plastics, are those coming from crude oil, or like is there? That's what's required, right?
Yeah.
To build plastic items. Okay,
Right.
so that's in everything. That's in your computers. I'm looking at a monitor here. There's plastics everywhere.
Right. The whole petrochemical industry. I would think the derivation of petrochemicals is petro, which is petroleum, which speaks to oil. So we can't do without it. And I can get on a soapbox, but I think fossil fuels, oil, gas, coal, and fossil fuel companies really have gotten a bad reputation. Because I think, when people think about the energy transition, people smarter than me call it the energy addition, because as we just described, you need fossil fuels, and great that you'll have renewables, wind and solar. But the implication that these oil and gas companies are bad stewards of the environment, I think is just totally false. These companies are also simultaneously investing in renewables, i.e., wind and solar, and have greenhouse gas emissions reduction targets, and they're doing yeoman's work. And the other way to think about it, the oil and gas companies, provide vital infrastructure, and if you want to invest in clean energy, who's better to supply the infrastructure than the oil and gas companies, which is what their expertise is. So I may be biased, but I'm very, very, very confident in the future of oil and gas.
Yeah, absolutely. I was looking at your the mission statement on your website, right? And you talk about a value-driven approach to the energy sector as it transitions toward a decarbonized future. So you're absolutely keeping your eyes open and looking at not just fossil fuels, but like you said before, a lot of these companies are also looking at solar and wind. Now, before we move to sort of the decarbonized side of the conversation, just a couple of more questions on this. So everything that you've talked about so far, this tells me that there is still great opportunities for investors to look at energy companies. And what are some of the things that you look for before you invest your clients' money into these types of companies?
Yeah, and I'm so fortunate because I have the energy background and that I was a fundamental analyst. One of the first things, I'm concerned about, investing in income, investing in dividends. I want to be really confident of the stability of the cash flow to support the dividends. So I look at, what's generating the cash flow, and how sustainable is that cash flow stream. So that's number one. Number two, you need a strong balance sheet. And talking about, perception and misperception, the energy companies across that value stream that I was discussing before, albeit the E&P companies, the midstream companies, and even the refineries that refine the gasoline, they've done a remarkable job of cleaning up their balance sheets. So the companies I look at are nearly all of them are investment grade companies. Talks about the integrity of the balance sheet. So and that's different than what it was before. The upstream, the exploration and production companies, were real destroyers of value, because their mindset was grow, 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 produce more, 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 and they outspent their cash flow. Today, that's totally different. They're living within their cash flow. They're actually managing their companies to generate free cash flow. So, what does free cash flow mean? It means, what's the money left over after they reinvest in the company, after their capital expenditures. And today, those companies are generating significant amount of free cash flow that range from 5% to over 10% of the value of the stock. So that also speaks to the safety of the dividend when you're generating that much free cash flow. And it also speaks to the fact that these companies can raise their dividend. So they learned that they need to focus on returning cash to shareholders, i.e., pay a dividend that's growing over time, and also return on capital, to make sure they're investing in projects that return an adequate capital. So we're looking at the sustainability of the cash flow. We're looking at the strength of the balance sheet. And the other thing where folks could get tripped up is we look at their debt maturities. So you can be a solid company, but if you have too much debt coming due in any one year, that might present a problem for you. So we look at the debt maturities, and we don't want in any one year that the company is going to rely on the debt market to refinance their debt. We rather see them do that in a methodical way, so they don't overburden their income statement. So liquidity is extraordinarily important for me. And then the other thing that I look at, besides just the fundamentals of the business, I also look at management and the culture of the company. And that might sound kind of wishy-washy, but I firmly believe this. A really poor management team can really screw up a great company. And conversely, a great management team can turn around a company that's mismanaged. And I believe that the culture of a company starts at the top. So I like to, have the opportunity to visit with management teams and understand what their philosophy is, and how they approach risk. Because again, going right back to the beginning of the answer to the question, I want to make sure that the dividend is safe and has some upside to it. And if I don't feel comfortable with the management team, I'm probably not going to invest in this stock.
That is great. I've seen on your website, you've got videos where you're actually interviewing the CEO and the CFO of companies. You actually talk to the management, which is fantastic. What about individual investors, the everyday investor, which is most of the people in our audience? How would they know that it's a quality management organization, right? How would we know? Like, we're not going to have the time or the resources to go call up the CEO and talk to them. Is there anything that we could do as investors to make sure it's a quality management running the show?
Yes, I think if you go to the individual websites of the companies, and there's always a tab for either investors or an overview tab that talks about the leadership of the company. So you can look at the bios of the management team. And the other thing that people may overlook is the board of directors. And I'll look at the board of directors because um, I just don't want and how many of the members on the board are independent versus just management people. And you typically, maybe you'll have at least one management person on the board, but maybe two, and then you just want to see independent managers after that, and then you could just look at the track record, and that's if you see that the company, and it's very easy to look at the website, and if the earnings are going up and down, up and down, up and down, chances are it's not necessarily a company that you want to invest in. So I would strongly urge investors to look at the website, look at the presentations that the company gives, and you'll have a decent feel for the management team. And I'm very lucky. I'm on one publicly traded board, and I can tell you that what they emphasize first and foremost is safety. And you may ask about ESG, but that's important from just the idea of how do they think about safety, and how do they think about the community and social issues, which are again sort of intangibles, but it gives you a sense of the quality of the management team in terms of what's really important to them. And if they don't have a good safety record, then you really should stay away from the company.
Yeah, I'm glad you mentioned ESG. So are you talking about, and correct me if I'm wrong, is this more of the G portion of it, the governance? Would that mean we're looking at a quality company if they are doing good governance? Or is there more to that?
Well, it's good governance, and the social aspect of it is important as well. And the E, the environmental, is important too. You want to invest in companies that are good stewards of the environment, and so I pay attention to that as well. It's received less attention, recently over the last couple of years, because I think people make a mistake if they just look at ESG and say, "Oh, I want to invest in a company that is very vocal in terms of ESG and very vocal in terms of reducing emissions." Getting back to what's a good investment or not such a good investment. If you look at some of the companies, I never invested in British Petroleum, BP, the European major. But they decided to really go green and invest in clean energy. And if you look at the stock before, and now at the Elliott management team, which is an activist group, is really critical of the company because they went big into investing in clean energy projects and de-emphasized their oil and gas business, which is the basis, really is the crux of what they do. And that's fine to invest in clean energy. But what they missed is that you need to generate good returns. And if these new technologies are not generating good returns, then I don't think you're doing your fiduciary duty. And so it's a long-winded answer once again, but you do want to focus on the environment and are they good stewards of the environment, but more importantly, are they good stewards of the shareholders' money? And investing in projects that don't generate good returns is not good use of shareholder money.
Yeah. Could you? This is A great topic, the ESG. Could you let our audience know what does the E, S, and G stand for? And part two to that question is how much weight do you put on a company's ESG
Right.
rating?
Well, E is environmental, S social, and G governance. And all three are important. But to me, the ESG is not what drives my investment decision. It's really after the fact or after the final decision. It's like, okay, like they check all the boxes. Cash flow stable, strong, strong balance sheet, liquidity is good. Looks like they're growing the dividend. Company pays a good yield. The dividend is well covered by cash flow, and I think it's growing. So from a valuation perspective, it looks like a good investment. Oh, and by the way, how do they rate in ESG? And if ESG is below average, and there's several rating agencies that look at ESG, maybe I want to relook, the company. But if I can check the box and say, they score well on ESG, then I'll invest in the stock. The other thing that the audience should be aware of, the issue with ESG is you have several different rating agencies, and they don't necessarily have the same criteria. So literally, you could rate high on MSCI and rate poorly on Sustainalytics because they're looking at different things, but it's an ESG rating. And I may do the same thing if I was a company and I rate highly on Sustainalytics. I publicize that and not necessarily let folks know that I didn't do so well on MSCI. So the devil's in the details.
That is interesting. I didn't know that. So there's different companies will give their own ESG rating.
Yes.
Oh, interesting.
Well, you have Moody's and S&P.
Yep.
Back in the credit crisis, one of the issues was the fact that the bond rating agencies all had the same criteria and all had pretty similar ratings. So there's positives and negatives to the fact that you have different criteria looking at the same set of factors.
Mm-hmm. Okay. Now, as of this recording, it's sort of middle of May. There's been a lot of turmoil in the markets, a lot of noise in the media the last 8-9 weeks. So there is a lot of uncertainty and fear for a lot of investors. And I noticed on your website, I guess it was a newsletter of some type in the April last month version, you talked about a useful gauge of risk, and you said it's the CBOE, Volatility Index,
Right.
or the VIX.
Right.
Or I like this one, in quotes, Fear Index,
Right.
which is a real-time measure of the 30-day expected volatility in the S&P 500.
Right.
How much consideration should investors put into that? If the fear index is high, should we just sit back and hold our cash? Or should we continue to invest as usual? What do you suggest?
I think you need to be aware of the volatility index, and just be mindful when the volatility index is high. And I think it got as high as 60 at some point. Typically, you want to see the VIX below 20. It's 16, 17, 18. So when you see the VIX high, it's indicative of volatility, and it's also indicative of fear. And at that point in time, you probably want to apply the Warren Buffett idea, which is when people are, and I'm going to get the quote not exactly right, but when people are fearful, I'm greedy. And when people are greedy, I'm fearful. And so what I would suggest at the very least, when the VIX is high, I think it should be a cautionary signal, because what it says is that there is uncertainty, number one. But number two, it also suggests that there's probably excessive fear in the market. And the best investors, keep their emotions in check. And so you just don't want to be spooked into selling at the wrong time because there's high volatility. And that gets back to what you do and what I try to do, which is invest in companies that generate stable income and have dividends that are sustainable. Because those companies are going to be able to weather the storm pretty well. But like anything else, the stock price might go down because of the weight of the market. But if you have the patience to ride it out, you do quite well. And if you invested when the VIX was at 60, you would have made a significant amount of money because the market has bounced all the way back.
That was my next question. I was just curious: is there a direct correlation between the VIX, the VIX, when it's high? Does that mean that the market is low, or vice versa? Is there any kind of correlation at all, or no?
Well, I'll be talking out of school if I said that I know what the correlation is. But typically, when the volatility index is high, stocks are under pressure, and typically they've gone down. And for folks that have been in the market a long time, there's a concept known as capitulation, which is you have high volatility, you have extreme fear, and you just see the markets sell off with high volume. And basically, it's people saying, "Gosh, I'm just capitulating. I'm out of here. Goodbye. See you later." Well, another way to think about that is, if everybody just sold, who's left to be selling? And so some folks see that as a signal. Maybe now it's time to get back into the market. So so when valuations are attractive, even with a high VIX, I think you start buying some attractively valued stocks that pay nice dividends.
Yeah, and I think
easier said than done, but because it can be scary.
No, absolutely. And I think this is where investor psychology and mindset comes into play, right? Are you going to be able to sleep at night after you've purchased X number of shares or you've invested so much money into the market? And you touched on it before briefly, where you want to try and be patient, disciplined as an investor. How does somebody become a confident investor?
Well, I think one of the ways you become a confident investor is, know what you're investing in. And I feel very comfortable in investing, in the energy companies that I know. You mentioned, the videos that I've done, interviewing company managements. And last week I did one with the CEO and CFO of a company called OneOak. The ticker there is OKE, and they have a slide in their presentation that shows their cash flow over going back to the credit crisis, going back to COVID, going back to when oil prices collapsed. And what's really interesting is that their cash flow grew throughout that period. So if you know the company, that gives you pretty good confidence. The other thing that I think is really important is make sure that you have a cash cushion. If you know that you have a child that is about to start college and you're going to have to pay for tuition, well, start raising the cash for the tuition payment ahead of time, because you do not want to be forced to sell stocks when the VIX is 60 and the market just got crushed. So I think you should have confidence if you know that I don't need to raise any cash. I can just wait this out. And so, and invest in money that you feel comfortable with, that I'm not going to have to sell at the wrong time. And I can wait out these periods of turmoil, because there's always going to be, some turmoil. But if you know the companies and you keep your behavior imbalance, you should be, fairly confident that you're going to ride out the storm.
Yeah, and I think this is where the dividends help tremendously, because if you've got a sufficient size portfolio where the dividends are covering your living expenses, then you don't have to panic when the market tanks to sell. You don't have to sell your shares.
Right.
And as long as the dividends are growing, you'll be fine. Now, we talked about earlier about you're looking at quality companies, you're looking at the history of the dividend payout, and all of the things that you look for before you invest in a company. What would cause you to sell if you owned shares in a company? What are some of the red flags that you would look for that would make you sell?
Well, I think one is, look at fundamentals and, has anything changed? I learned this, back a few years when I was many years when I was an analyst, and a company made a major acquisition, and they said that we think after year 3, this will be additive to earnings and cash flow. But between now and year 3, it's going to be dilutive. So our earnings are going to go down, but we're making this investment because we think it's a great long-term investment. I think that's a red flag. I don't want to wait 3 years to find out if this was a good transaction or not. And so there you have, a real, fundamental change in the company. The way I like to say, I like to think about, how does a company, manage risk? And if a company does a huge transformative transaction, what if they're wrong? That's at least a yellow flag for me, because I want to invest in a company that understands risk and understands that if we're wrong, we're not going to jeopardize the dividend. We'll be fine. And if they go out and do something that is, a large transaction that goes wrong, well, that's another yellow flag. And the companies I invest in tend to have, very little commodity price risk. So the fact that all prices, went from 75 to 58, I wasn't that concerned about the viability of the companies that I invested in. But if I had a company that was exposed to the price of oil, that would be something I'd be afraid of. And then I'd be remiss not to say that sometimes companies get overvalued, and so what I would do there, if I feel very comfortable about about the long-term viability of the company, but maybe I'll sell some stock in order to buy another company that I think is more appropriately valued. But I think people can make the mistake of trading in and out with the idea that I'm going to be able to call the top and I'm going to be able to call the bottom. As long as fundamentals are strong, I think you should be cautious in terms of when you sell. The other common mistake I think people have made, and I make, is I don't want to pay taxes on this, so I'm just going to hold off selling until it's long term. That might not be the right decision. If a company just did something and you think it was a bad decision, just get out of the stock, pay the taxes. I mean, that's a good thing. If you have to pay taxes, it means that you've made money. Pay the taxes and move on. Don't wait another 2 or 3 months to have a long-term capital gain.
Yeah, that's good advice. That's good advice. I think sometimes we, as investors, sometimes we almost fall in love with the company and we just tend to hold on to the stock forever and ever and ever. And I think your advice is so important. If the company is overvalued, you may want to take some shares off the table and reinvest them into something else.
Well, it's funny. I actually teach a mini course for graduate students at a city college here in New York. It's a behavioral finance course, which basically looks at how investors make decisions. And one of the decisions that investors make, which is a bad decision, is that they hold on to their losers and are reluctant to sell their winners. And it should be just the opposite. And the reason that folks hold on to their losers is because they don't want to recognize the pain of selling a stock that they lost money in. So they rather enjoy the feeling that they get by selling a stock that they have a gain in. And, just from a tax consequence, well, if I sell a loser, there's a tax benefit to selling a loser. And if I sell a gain, I have to pay taxes on a company that seems to continue to be doing well. So that just reminds me of some of the bad decisions we make because of just not good behavior.
That's a great story. I am guilty of that. I held on to stocks for far too long.
Yeah, just suck it up, man.
That's right. You mentioned this course that you're teaching, behavior finance course. What made you want to teach this course?
Just because I have an interest, in it. I was taking a seller out of Penn Station in New York. I forgot where I was going, but I happened to stop into a bookstore, and there was this book called Nudge, written by Richard Thaler, and it introduced me to behavioral finance. The sort of the thesis behind Nudge is the best way to describe it is an anecdote. Let's say you're trying to lose weight, and you're in a bar, and there's peanuts in front of you, and you don't want to eat the peanuts, but because they're in front of you, you'll eat the peanuts. Well, if somebody just pushes the peanuts away, chances are you're not going to eat the peanuts. And the other example that he has in the book is one that you're a new employee. You just get hired, and they give you this form to fill out, your benefits form, and it says, how much money would you like to save out of your paycheck? And most people pick a number that is way too low. Let's say it used to be, fill in the blank. Well, maybe you'll do 2 or 3%. But if you present the benefit and say, do you want to invest 5, 7, or 9% of your paycheck? Most people will be nudged into doing 7%. It's just in the middle. So that introduced me to how people make decisions and how you can nudge people. And then I just read another book written by Richard Thaler that was a little bit more academic. And so, very selfishly, I was teaching a financial statement analysis course, and I made the mistake of asking the head of the department, have you ever considered having a behavioral finance course on the curriculum? He said, that's a great idea. Do you want to teach it? So and I say selfish because I'm really interested in the topic. And so it enables me to nudges me, if you will, to keep learning about how we make decisions.
Yeah, that is great. That's incredible. So much of the psychology and behavior comes into all of the decisions that we make every day.
Yeah.
Now, having taught students in this course, what is the number one mistake that you find the young folks are making when it comes to investing?
Well, I think what we discuss is just holding on to losers. I think the other is overconfidence. This idea that I can do better than the market. This idea that I can pick the top, I can pick the bottom. The greater fool theory. I think the stock is overvalued, but it's going up. So, I'll be smart enough to get out before the next guy. And by the way, overconfidence is a problem that professionals have as well. Especially when folks are trying to project cash flow, years out. It's not an easy thing to do, and so you mentioned my website, and I have certain principles on the website. One is always act with humility, because this is a difficult thing to do, and we're going to make mistakes. So own up to the mistakes and recognize the fact that we're not infallible.
Yeah, absolutely. I love the 8 principles you have on your website. If you don't mind, we're going to put a link to that in the description below.
Oh, okay, thank you.
I would want everybody to read those. That is fantastic, having those 8 principles there. We're almost out of time. I'm sure we could talk about this for hours and hours.
Yeah.
One of my favorite topics here. So, Yves, where can people find out more about you? Do you have a website? Are you on social media, or what are some of the links you want to give out, and we'll put them in the
Oh no, I
description.
appreciate that. For my company, I didn't come up with an original name. It's Siegel Asset Management. I consider myself a regular guy, so Sam for short. So my website is www.siegel, my name, Siegel, asset, MGT for management. So it's www.siegelassetmgt.com. That's the website. And we're also on LinkedIn under my name, as well as Sam Partners. And I appreciate you letting me plug the website. Thank you.
Oh, you're welcome. So that's great. Well, we will put the links down below for anybody who wants to take a look at it. Like I said, take a look at the 8 principles. The website is great. There's videos there with Yves interviewing management from various different companies. This was a great conversation. Like I said, I've been naive about sort of the energy stocks and the midstream. I hope this has been educational for our audience. Yves, I want to thank you so much for taking time out of your busy schedule to speak with us today.
Well, thank you so much. I enjoyed the questions. Thank you.